to our second virtual Friday coffee. We appreciate you guys coming, and we're really excited. We've got Jeremy Morris here with us today. So just wanted to start out with a couple of housekeeping items. So if you'll notice that everyone is muted right now, the reason we did that is just to kind of cut down on some background noise. And then another item I want to talk about is you guys will all go to gallery view, or I'm sorry, switch from gallery view to speaker view. And that'll help you to see a speaker when they're speaking and be able to switch back and forth automatically. And if you guys have any questions, go ahead and put those in the chat window. And if you're not familiar with how to get to that, you would just hover over the bottom of your screen and hit that little chat button. And you can type in your questions there, or if you have troubleshooting issues, you could also type those in there, and I'd be happy to help you guys out. So I will go ahead and pass it along to Sean to go ahead and get things kicked off.
Okay, thank you, Kels. Thanks for everyone attending this morning. Driving in, obviously everyone can see that it's kind of a gloomy Friday in April, but it looks like the weather's going to break next week. Like Kelsey had indicated, please, once Jeremy begins, and when we're going through the slides, or when Jeremy's going through the slides, please, if you have questions, send them in, type them into the chat box, and Jeremy will cover those questions for you. Again, I would like to thank Jeremy Morris from Williams Keeper. Jeremy's a member there, and his right hand, or I should say the person that probably runs Williams Keepers, Jennifer Backus. She's helping us out as well today. So thank you, Jennifer, for all your help. Again, what I would like to do is just, I'm going to turn this over to Jeremy and let him start the presentation. And hopefully everyone can see the PowerPoint presentation on the screen. And again, if you have questions, just type them into the chat box and we'll get those answered for you. Without any further ado, I'm going to pass the shoe to you, Jeremy.
All right, thanks, Sean. Appreciate it. Happy to have everyone here this morning. As Sean said, really excited to be here. Jennifer, I thank her for her help in getting this done. This is something that we as a firm have been obviously dealing with a lot over the last month. It feels like more like a year, but hopefully, again, it's continuing to evolve. For example, the PPP that we talked about last week. We got some news that we expected, I guess, yesterday, that those funds are out. So, again, it's always moving. So we'll do our best to, provide most up-to-date information. I see that my one of my fellow partners from Columbia, Mark Gingrich, is on this call. Mark and I in particular is with others in our firm, has spent a lot of time on this. So I'm happy to have him here as backup in case I misspeak on anything, which could happen. But so what we want to do today is take a look at what tools we have associated with trying to navigate this, because at least in my lifetime, this has been unprecedented in a level of disruption. And, obviously the most important piece of this, and we don't mean to diminish, and by talking about the business side of it, we don't mean in any way to diminish the health side of this. Obviously this is a health crisis first and foremost, but it has had an unprecedented level of disruption on our business community. And I'm not a medical professional, I'm a CPA. So, we'll be talking, I'll stay in my lane and we'll talk about the business side of it, but I don't in any way want to diminish, the health side of that. But given that, given the amount of disruption, what we hope to do today is run through some of the tools that are available to business owners. And again, that's going to differ depending on your situation, but at least if you know what tools are available, then work with your advisor or advisors, whoever that is, your accountant, your banker, in making sure that you're picking the tools out of that toolbox that are most applicable to your situation. So really, as we think about this, as I mentioned at the beginning, we've been dealing with this for about a month. This Families First Coronavirus Relief Act. Really, as we think about what has happened, there's really been two main relief bills recently that have a lot of these changes that we'll be discussing. The first one is the Families First Coronavirus Relief Act. As I mentioned, I think that was passed almost a month ago exactly. I believe it was March 18th when that one was passed. And again, it feels like an entire lifetime ago. That was typically, at least as it relates to what we'll be talking about today, focused on, taking care of your employees, making sure those that have to miss work due to reasons associated with COVID-19 will have relief options available to them without producing a burden on the employer to provide that. So we've got two different types of leave. We'll talk about that here in a moment. But both of those, the leave that's required to be paid under these, are reimbursable to the business in the form of a payroll tax credit. And the mechanics of it, there was some discussion about it in the beginning, but it's done in such a way to hopefully minimize the lead time between when that leave is required to be paid to employees and when the business gets reimbursed by the government associated with it. So that was the first one. Then on the 27th of March, we got the Coronavirus Aid, Recovery, and Economic Security Act, or the CARES Act. I wonder sometimes if those in Congress spend as much time figuring out how they're going to name these things and what acronym they're going to use and what they will put in the bill based upon how some of these are written. And that will be the only political comment I make this entire session. So the CARES Act, it gave us some additional tools, so to speak, related to this. The biggest one of which, and we'll spend some time about it, talking about it, but our friends, Jason Schwartz, Leslie Tanner did a really nice job last week discussing those issues related to the Paycheck Protection Program. This has kept us in the accounting profession on our toes. It's definitely kept our banking friends on their toes. This was probably the item that received the most, attention. And again, happy to field questions about it today. We'll talk about it at a high level. As I mentioned at the outset, though, as of yesterday, so the 16th of April, the SBA announced the Paycheck Protection Program ran out of funds. And when I say ran out of funds, that's $349 billion worth of funds that were set aside for this program. And I'll be honest, in some circles, it lasted a week and a half longer than other people thought it might. There was some concern, given how things looked at the outset, that it may not last through that first weekend. So again, we got almost 2 weeks out of it. There are ongoing discussions about whether or not there will be additional funding, but that is kind of a little bit of a political hand grenade at this point. So we'll see if they can get anything done related to that. In addition to that, though, there are other options that will either provide current cash flow savings via a deferral of payment of taxes, or additional tax credits for various, reasons. Probably the most important of which is retaining employees. Now, the key with this is where this has been interesting is some of these tools don't necessarily work well together. In other words, you're receiving PPP funds or forgiveness of PPP loans, and again, we'll talk about that again at a high level in just a second, may preclude you from being able to use some of these other benefits. So that's something to keep in mind. I would say at the outset too, as it relates to how some of these things fit together, and we'll mention it at the end of the presentation, we've produced a bit of materials on this as it relates to, taking a look at various generalized situations, as it relates to, how to potentially maximize, loan forgiveness under the PPP, given the information we know now, as well as identifying those things we don't. All of that information is for free on our website. And I'm sure we can make these slides available to you through the chamber as well, if you have any questions after this. So those are really the two big categories that we want to look at: the aid relief related to Families First Act, relief related to CARES Act, how these fit together, and then open it up for questions, and we'll just see where that takes us. All right, so the first one, this Families First Act, tax credits for taking care of employees, as I mentioned. And so the first of this was the emergency sick leave. So what this applies to is employers with fewer than 500 employees. And we'll see that 500 number matters a bit. We'll see throughout a lot of these, that tends to be the magic number. But if you have fewer than 500 employees, it requires your business to provide up to 80 hours of sick leave to employees that have to miss work for some very specific coronavirus related reasons. And so we've broken these down into two categories. The Act lists 6 different categories that require you to pay leave, but that 6th one really is it gives them the ability to identify more situations in the future, and they have not done that. So really, for all intents and purposes, as we sit here today, there are 5 reasons that would require a business under this Act, effective April 1st, to begin paying their employees, whether they used to or not, for leave related COVID-19 related reasons. And so the deal with that, though, is in order to not produce an undue burden on the employer, again, given the difficulties economically these days, is that there is a refundable payroll tax credit that is provided to the employers to help them recover, or to allow them to recover all of the amounts paid that are required to be paid under these acts. And I did emphasize payroll tax credit because, again, if you have a not-for-profit entity, you may be wondering, well, what does a tax credit do for me? Again, it's not an income tax credit, but it is a tax credit against payroll taxes paid, and it is also a refundable credit. So again, if the amount of the mechanism is you get to hold back any amounts that you would pay as payroll tax deposits in the next payroll tax deposit cycle. To the extent you've paid leave under this Act, the amounts that you paid, you get to hold back as opposed to paying in as payroll taxes. And then to the extent that the credit would exceed that amount, you get a refundable credit. So the credit amount breaks down into 2 different categories. So the first one we've just kind of termed problem with the employee. So in other words, the employee is under a federal, state, or local quarantine individually, or they're under quarantine based upon the advice of a medical professional. And so they're experiencing COVID-19 related symptoms, or they're seeking a medical diagnosis. If that's the case, the employer, effective April 1st, is required to provide 2 weeks of paid sick leave. The employee cannot be required to use their own sick leave first. Okay, so this leave is provided 80 hours at their normal pay, at 100% of their normal pay, up to $511 per day. And we say normal pay because if someone is part-time, then it wouldn't be the full 80 hours, but whatever their normal hours would be during that 2-week period. So again, paying them at 100% of their normal pay, up to $511 a day. To the extent you do that, you then are eligible for a payroll tax credit of 100% of the amount you pay, again, up to their normal pay, up to the maximum $511 a day. Now, if for some reason their normal pay is more than $511 a day, you're only required under the Act to pay them the $511. You can pay them 100% of their normal pay above the $511, but you don't get extra credit, so to speak. All right, you're paying your own way after the $511. So what I mean by that is the credit maxes out at the $511. You can pay more, but you're not going to be reimbursed for that difference. Now, the second set of scenarios, and this is the one we've probably seen most often, is what we call an issue with the employee's family. So the employee is caring for someone subject to a quarantine that's been advised to be under quarantine, or they have to have leave to care for a son or daughter whose school or daycare is closed due to COVID-19, and that's everybody. In this situation, you're required to provide up to 2 weeks of paid sick leave at 2/3 of the employee's normal pay, up to a maximum of $200 a day. Again, you can pay them at 100% of their normal pay if you like, but you're only going to receive the payroll tax credit on up to the $200 a day. So that's the emergency sick leave. That takes you through the first 2 weeks. In addition, FMLA typically kicks in, okay, for situations, particularly as it relates to someone experiencing, having medical leave related to COVID-19. But what they did in conjunction with this was provide an expansion of FMLA. They provided a 12-week expansion of FMLA to cover that second issue, which is to take care of a son or daughter whose school or daycare is closed related to COVID-19. So again, we have the 5 reasons for the emergency sick leave that covers the first 2 weeks. After that, and that also covers 2 unpaid weeks of FMLA as it relates to taking care of your son or daughter who has to be home because the school or daycare is closed. After that first 2 weeks, the employers now, again, same issue, 500 or fewer employees, they are required to provide up to 12 weeks of FMLA related to, again, the reason about having to stay home because your son or daughter's school or daycare is closed due to COVID-19. After that first 2 weeks of unpaid leave, which coincides with the 2 weeks of paid sick leave, the employee is eligible for another 10 weeks of paid leave at 2/3 their normal pay, again, up to $200 a day. Again, just to reiterate, that only applies to that situation where you have to stay home, you are unable to work, you are unable to telework because your son or daughter's school or daycare is closed. That's the only situation. Any of those other medical reasons, you may be eligible for FMLA, but is not required to be paid FMLA. That one reason is the only one. So if you have that situation, that individual, you're required to pay them for 12 weeks. Again, 2 weeks under the emergency sick leave, 10 weeks under the FMLA plus or expanded FMLA. You're only required to do it at 2/3 of their normal pay, up to $200 a day. And just with the emergency sick leave, you can choose to cover that at an amount greater than $200 per day, but you're paying your own way at that point. You will not be eligible for the tax credit. So that's the Family First Act. We spent a lot of time at the outset, talking about how this would impact, individual specific circumstances, how it plays with, leave benefits that businesses are already provided. But the whole point of this was to try to give people some security that were unable to work or telework associated with COVID-19. And then, so that took us through, again, almost 10 days. And then we got the CARES Act, which I believe was the third tranche of aid, as it relates to COVID-19. The big piece of this was a Paycheck Protection Program, and this, again, we don't necessarily need to go into it in specific detail. We talked about it last week. And again, as we sit here today, the funding is gone. But the point behind this, again, was looking at businesses with 500 or fewer employees and providing loans based upon historic levels of salary, specifically 2.5 times your average monthly payroll for 2019, up to a maximum of $10 million at the highest level. What it was is the SBA was providing loans to businesses that could be used for payroll, mortgage interest, rent, and utilities for the 8 weeks after receipt of the funds. To the extent you use them on those items, and again, these are expenses that a business is likely to incur, even if business is slowed or shut down, rent, utilities, mortgage, and expenses to help keep your employees on the payroll. Okay, that's what we were trying to accomplish. That's what they were trying to accomplish with this. Oh, 1 second, I'm hearing, you having issues with the audio? Can I get?
I can hear you. I can hear you fine, Jeremy.
Okay. I can hear you fine too. I've gotten a few messages saying that they couldn't hear you, but I think it might be isolated to the WK office.
Well, they don't want to hear me anyway. I mean, they have to listen to me on a daily basis. They probably have me on automatic mute.
That may be the problem. Okay, it looks like everybody else can hear you okay.
Okay. All right, sounds good. Okay, so again, trying to keep people employed, all right? They're providing funds that would allow business to keep their people on the payroll without providing an undue burden as it relates to cash flow. The catch with this, though, is they want people to the extent you spend them on those good costs, as we'll call them, during the 8 weeks, any amounts expended on that loan becomes a grant. Okay, so you get forgiveness associated with it. However, that loan forgiveness can be reduced if during that 8-week period you either have a reduction in the number of people you're paying, and again, looking at how many full-time equivalent employees we have during that 8 weeks versus what we had during a baseline, or did we keep this right number of people but not pay them enough? In other words, did we reduce salaries and wages significantly? And by that I mean more than 25%. If either of those things happen, even if you spend 100% of those loan dollars on good expenses, the loan forgiveness is going to be pulled back a little bit, okay? The loan forgiveness will be reduced in a proportional way. There is, however, a catch to this, is that if you fail one of those tests, there's a way to make it up. And that is, do you correct the reduction in employees, or do you correct the reduction in wages by June 30th? If you do that, then everything will be fine. Now, the problem is there's a lot of complexity associated with this. And I would direct you to a white paper on our website. Again, Mark Gingrich, who I mentioned on our phone call, was the mastermind behind that. It kind of walks through some of these situations, because that's what we're going to be dealing with as advisors. Is, you know, a lot of the businesses we work with have received the loans. And so the question is going to be, what do we do to maximize forgiveness? And we'll talk about that, you know, a little bit later. But there's still a surprising amount of complexity for something that in theory is relatively simple to understand. There's a bit of complexity and a bit of uncertainty related to it. So we're going to have to work through that. We're going to have to get guidance associated with it. But that was the big piece. Now, in addition to that, well, I guess before we move off of this, I will just mention that, you know, part of the confusion came in is in the way this was written, it focused on two different types of businesses. You know, what you would think of as, you know, normal operating businesses, multi-owners that have payroll. And then it also was meant to apply, and does apply, to self-employed individuals. The self-employed individual, the application process for them opened up last Friday, and which was April 10th. And we got guidance explaining how that situation should work on April 14th. So again, that's kind of the way things roll as it relates to some of these programs. The guidance comes in a little too late, but it did at least come in 2 days prior to the SBA running out of funds. So hopefully, you know, a good number of self-employed individuals were able to get in under the program. We just bring this up to say, if more funding is available, in addition to being able to get a loan based upon the amount of wages you pay, if you are a self-employed individual, and by that you have net income, 2019 net income on a Schedule C, that's how they calculated it. That's the measurement period that SBA and Treasury is going to use. You can also get, as part of your loan, income replacement based upon 2.5 times your average monthly 2019 Schedule C net income, not gross income, but net. And then your forgiveness then is based upon 8 weeks of that same 2019 income. So that is, if you're self-employed, you haven't been able to access the funds. If more funds are made available, it is available to you. Now, what they were silent about was how this impacted farmers. They don't explicitly mention Schedule F income in the guidance that SBA issued on the 14th. My hope and assumption is that to the extent you have self-employment income associated with a farm, it would be treated in the same way that the Schedule C income would be, the non-farm income. As long as it's related, as long as it's subject to self-employment tax, it's hopefully available. They were also silent on Schedule E rental income, but I don't think the answer is necessarily as good in this situation. I think to the extent they keep mentioning over and over repeatedly self-employment income, okay? And they do reference sections of the code that talk about self-employment tax. So I think if you have a rental business, you're leasing rental real estate, and it's not subject, which it won't be by statute, it is not subject to self-employment tax, even if you're a materially participating real estate professional. I am much less confident that that income will be subject to it. So I think this helps sole proprietors. Hopefully it helps those in the farming community. But again, they were a little unclear. They just didn't speak to the farm income. But I do think it may shut out those people with rental income. So that was a big piece of it. In addition to that, though, there were other provisions that were put in here to try to help secure cash flow. And this next one isn't something that's going to lead to a reduction in tax or a tax credit, but it is a deferral. So as it relates to the employer share of Social Security taxes that were due from date of enactment through the end of 2020, this provides a deferral of having to pay the employer piece of those Social Security taxes. So again, it doesn't eliminate the Social Security tax. It doesn't provide a tax credit, but it is a deferral. So instead of having to pay those throughout 2020, when the situation, cash situation may be questionable or tight, you can defer payment of half of that until December 31st, 2021. The remaining 50% of that will be due on December 31st of 2022. There is a catch though, and this is something that we kind of tried to talk through in another white paper, on our website. Some of these don't necessarily play well together. So if you take advantage of this, you can do that. You can, as we sit here today, you can take advantage of this, even if you've accessed the PPP loans. But as soon as there is a judgment made or a decision made that you're at the end of the 8 weeks, part of or all of your loan is forgiven, then this deferral is no longer available to you. They've assumed you received the PPP funds. You received basically a grant through the PPP. So we're going to close off the use of this deferral. So again, every business today, given that nobody can be through that 8-week period, can utilize this deferral of employer payroll taxes. But as soon as you get forgiveness under the PPP loan, you're back to having to make normal deposits of that payroll tax. This next one is a tax credit. But again, it is a tax credit in lieu of the PPP. So we'll just say this out the outset. If you have received PPP loan funds, regardless of whether any of them would be forgiven or not, you cannot access this tax benefit. This is an either or situation. But depending on what has happened to your business, the PPP lasts over 8 weeks. This in theory could take you through the remainder of the year. Maybe you get to a better outcome, but we'll discuss some of the cost benefits associated with this in just a minute. Sorry, let me stick to that. I'm sorry, I had it on the wrong slide. So the employee retention credit. The situation related to this is if your business has seen a significant downturn in revenue, or you've been forced to fully or partially shut down or suspend activities, you are eligible for a credit against the Social Security portion of payroll taxes up to 50% of qualified wages to an employee, maxing out at $10,000 of wages. So the maximum credit you can receive under this is at $500,000 per employee per quarter. Again, that's assuming that they had $10,000 worth of wages in that quarter. But as I mentioned, this credit is not available to businesses that receive what they call a covered loan under the PPP. So this is an either or proposition. So here's a little chart that discusses how you qualify. Again, like everything, there's a bit of complexity. It depends on what type of business are you. This does apply to not-for-profits. And again, as it relates to non-for-profits, has your business operation been fully or partially suspended during a calendar quarter after some government authority limited commerce, travel, or group meetings due to COVID-19. If you are a for-profit business, you can qualify under that, or you can qualify under situation 2, and that is you have had a significant reduction in gross receipts. And by that they mean if you're beginning in the calendar quarter in which gross receipts in which gross receipts are less than 50% of what they were in the same calendar quarter in the previous year, that's a significant downturn. So beginning with that, you are eligible for this credit. And again, depending on the size of the business, that dictates which employees and which wages you're looking at. But generally speaking, it's a credit of up to 50% of the wages paid to employees, again, up to the $5,000 credit max. Now this continues. So again, you've had a significant reduction in the amount of income that your business is bringing in. Again, less than 50% of what it was in the same quarter of the prior year. And that continues through 2020 until the first quarter after you're back up to at least 80% of where your gross receipts were in the same calendar quarter for the prior year. So again, if you've had a downturn in quarter 1, gross receipts were less than 50%, and then you stay at less than 80% of where your gross receipts were for the remainder of the year, or even through quarter 3, that will allow you to get the credit through all 4 quarters of 2020. But having said that, again, if you have accessed PPP funds, this isn't available to you. So going back then out of order. So the last thing I want to touch on related to this under the CARES Act, enhanced unemployment benefits. You know, we received a lot of questions at the outset about, does it make sense for me? You know, we've got to provide leave. We're wanting to access the PPP. We may have to shut down. Does it make sense to lay my people off temporarily, furlough them? Do we take the PPP funds, write it out, and then use the unemployment benefits as a, you know, as a bit of a safety net? And so again, those are some of the decisions that businesses had to make. Just want to make this available to you that this is here. Okay, so, and by here, I mean Department of Labor, I believe it was maybe 2 weekends ago, the Department of Labor finally issued guidance to the states. And I believe as of yesterday, Missouri Department of Labor has issued some guidance on its website saying they are about ready to roll this out and have given people some, if you go to Missouri Department of Labor, they kind of explain how this will work and what the first steps are that you need to do. But there's really two pieces of this. One is that it provided an additional $600 weekly benefit in addition to normal state benefits. In the state of Missouri, that benefit maxes out at $320. So again, you're looking at a total maximum of, you know, $920 potentially for weekly unemployment benefits. And that's available, you know, it's going to be retroactive. You know, through the bill, and then all the way up through July 31st of 2020, that piece of it. So again, an additional $600 per individual per week in benefits. In addition to that, it's also opened up a relief related to those people that would typically not qualify. And the state of Missouri is very clear to say this isn't unemployment insurance, it's a different program, but it's for those people that typically couldn't access unemployment. So whether you're a self-employed individual, I mean, that's going to be the big one, or someone who maybe has already exhausted their state unemployment benefits, you're eligible for this pandemic unemployment assistance. And this is the entirely new piece of this. But again, the state of Missouri is starting to roll this out. And so it provides up to 39 weeks of assistance for those who just can't otherwise access unemployment. And that will take them potentially through December 31st, 2020. So those are the, you know, it's funny. I mean, again, we've dealt with a lot of this, but, you know, other than the fact that these credits are associated potentially with payroll taxes, none of what I've discussed are really tax related issues. You know, these are all business related issues, business solutions, hopefully related to this, but they did throw some tax relief in this bill. Again, I would argue it's not a tax bill by any stretch of the imagination at all, but they did provide some tax relief in there as well. And so we've put this towards the end, mainly because this is something that's applicable to all businesses. This is something that as you work with your advisors, know that this is available to you and it's available to all businesses. It doesn't require the same cost benefit analysis or decision point that those other items did. You know, do I take the PPP? Do I do the employee retention credit? Do I furlough my employees and then try to access PPP? Do I access PPP, you know, in addition to using some of these credits? And then if I have to, you know, furlough my employees, these don't have the same set of decision points related to them. All right. And all of these are, again, trying to get cash in the hands of businesses as quickly as possible. So the first one you've probably heard about, it made our, you know, end of tax season a little, you know, I mean, this whole thing has been strange, but, you know, made things a little bit stranger for us in that it provided a deferral for filing and payment of income taxes for any taxpayer really that has a due date between April 1st and July 15th. It has extended the due dates of individual and corporate returns as well as payments associated with those tax returns. So if you owed a balance due, you do not have to pay that until July 15th. You don't have to worry about extending your return and making a payment until July 15th. In addition, it has also extended the quarter one and quarter two estimated tax payments that both would have fallen within that time frame. The funny thing about this is the original guidance that we got only extended due date and it extended the quarter one estimates. So you had a situation where tax return was due July 15th, quarter one estimated payments were due July 15th, quarter two estimated tax payments were due June 15th. They realized the kind of insanity of that. And so both quarter one and quarter two, as well as your taxes for 2020 and then your taxes due for 2019 have been extended until July 15th. In addition to that, the Tax Cuts and Jobs Act, that was the big bill that passed at the end of 2017. That seems like a decade ago. But that as part of that bill, it provided tax relief in some ways, but it also it pulled back in other ways. One of which was a business's ability to use what we call net operating losses. So if your business has a tax loss for a year, historically, you could originally take those losses back and offset income for prior 2 years. And then whatever amount you didn't use, you could carry forward. What the Tax Cuts and Jobs Act did is it eliminated the ability to take those losses backward. So there was no ability to immediately recover taxes anymore when you had a tax loss. In addition to that, it limited the amount of income on a go-forward basis that you could eliminate via the losses. You were maxed out at being able to eliminate 80% of taxable income in a carryover year. So even if you had losses carried over in excess of your income in the current year, you were going to pay some amount of tax because you couldn't get your taxable income down to zero. The CARES Act and the provisions in that have done away with that temporarily. So if you have net operating losses in 18 or 19 or 20, those losses can be carried back 5 years to a time when you had taxable income. And it also removes the restrictions on future use of those NOL carryovers. So you're not subject to that 80% limitation. Now, the situation with this is, twofold. In the situations where you had losses in 18 and 19, that's fantastic. Economy's been pretty good. Some, you may or may not have those, but it will be helpful as we look at 2020 when I think a lot more people will be in that situation. The other thing to keep in mind related to this, though, is just because we have the ability to immediately carry back losses, there's going to be some, I think, hold up on this in the IRS's ability to process these returns. The IRS is shut down all of their offices, and they are not working with a ton of staff as it relates to the processing, and they have admitted this. If you try to call the IRS, you can't even get in to be put on hold at this point. They have, however, allowed some of these returns to be filed by fax, of all things, so that it expedites the process of getting these in the hands of people that can process them. But I will say, just be aware, again, work with your advisor. If you had those losses, let's get those returns filed, get those claims for quick refunds filed, and just see that's all we can do at that point. And then we're at the mercy of the IRS and their ability to process those. Again, they are aware of the problem. They are trying to provide ways to get these processed, but it may not be as quick as what we would otherwise like. There were also provisions limiting your ability to take excess business losses. Those have been eliminated for 18, 19, and 20 retroactively. And then corporations that had alternative minimum tax credits, again, the AMT is gone. So if you had a credit, they were allowing you to take that over a number of years. The Treasury is allowing you to claim any remaining credits that you had in 2019. So you don't have to spread those out. You can get all of that tax back as a reduced tax liability in 19 or as a refund in 19. Okay. So again, trying to get cash in people's hands through tax benefits. Finally, they also put limitations on businesses' ability, at least larger businesses' ability, to deduct interest expense. And that was generally limited to 30% of taxable income, but you get to add back non-cash expenses such as depreciation, for example. So it was an adjusted taxable income number. They have expanded that to be 50% of adjusted taxable income. So again, increasing the amount that you may be able to deduct in interest expense. In addition, because they think 2020 businesses may have losses, the fact that they have increased the threshold from 30% to 50% of taxable income. If your taxable income is zero, that doesn't do you any good. 30% and 50% of zero is still zero. So what they've said in those situations, they don't want to punish you because they understand the economics of what's happening this year. We're going to have more taxpayers that have losses. If you're in that situation and you had income in 2019, you can deduct your interest expense based upon 2019 taxable income. Finally, for those of you that made improvements to properties, those of you that have real estate in your business or that is the business, there was a whole issue of qualified improvement property. God love them. They tried to make this subject to bonus depreciation, and by that, I mean, you can expense all of it in the year it's placed in service. God love them, they meant to do it, and then they wrote the bill in such a way where it didn't do it. And in the current political climate, it took a pandemic for them to figure out finally how to correct this on something that everybody agreed was miswritten. But either way, regardless of how we got here, we're here. So we're going to be looking at our clients that put some of this property in service, and look at whether or not what elections were made. Some of it was eligible for Section 179 expensing, not to get too technical. So some of it may have been written off, but in situations where you had losses, you were unable to do that. So we'll look at whether or not for our clients, to the extent they put this property in service, do we want to make that election now? And even if, and it can produce a loss. And so now we have the ability to create net operating losses that we can get immediate tax savings associated with. So looking to see how all of that plays together. So again, qualified improvement property, just a little note on that. Basically anything that it's improvements to an interior of a building, non-residential real estate. So if it's residential rental, I'm sorry, it doesn't qualify, but commercial rental property, so long as the improvements were done after the building was placed in service. And it's basically related to the interior, but it excludes enlargement of the building. It excludes elevators, escalators, and any internal structural framework of a building. Last thing we want to bring up, I want to talk about is something that doesn't really relate to the CARES Act, but there was a Federal Reserve memo. And it says, we talk about all of this, taxes and tax credits. A good piece of advice is if you are having cash issues, talk to those that you work with on the lending side to see if there's any relief available to you. Will they be willing to work with you to modify the terms of that to help get you through this period? So there's this interagency statement on loan modifications and reporting for financial institutions working with customers affected by coronavirus. They couldn't come up with a nice acronym for that. But what they're trying to do is telling banks, look, be flexible with borrowers if they need to make loan modifications resulting from COVID-19, because cash is going to be, maybe tight for a lot of these businesses, and to try to help alleviate any accounting or regulatory issues that may make that difficult to modify. So they're going to try to cut out some of the red tape, and they're asking banks to be flexible with borrowers. So again, could you take a loan where you're paying principal and interest? Could you convert it to interest only for a period of time? And then whenever things get better, try to go ahead and, go back then to making normal payments in that situation. So just some things to keep in mind. Again, this is something that kind of like those last tax issues we talked about. This is applicable to everybody. So I would definitely take a look at this, in your situation, and definitely use that in addition to whatever strategies you use. So we'll just cover this at a high level. As far as planning considerations, I only see, got a couple questions. So let's run through this. Let's see. Okay, let me run through this and then we'll hit these questions. So that, but as we talk about these, if you had the ability to access PPP, fantastic. To us, that's probably, in addition to those typical items that don't change, net operating losses, loan modifications, reducing expenses and conserving looking at your discretionary spending. All of that is stuff you should be doing. But if you were able to access PPP, that's probably going to provide the greatest flexibility as it relates to that. Now, if you're a business that doesn't have a lot of payroll, or you're a self-employed individual that didn't have income in 2019, that's likely not going to work for you. And then you start looking at these other credits, because again, once you access to PPP, you don't have access to these other tax incentives. But if you have the PPP, we're okay with that, because that provides a dollar for dollar offset against salaries, for example, and against rent, which is better than a partial tax credit. In addition, like we said, there are other loan options available through SBA. I would look at those if you aren't eligible for the PPP, and then look at the tax credits available for both providing leave, tax credits associated with employee retention, in addition to just best practices, reviewing discretionary spending, and looking at loan modifications. Again, the enhanced unemployment, just know that that's available, and we're going to get more rolled out related to that, but that does provide a safety net. Again, if you're looking at having to furlough people, there is a lot of complexity there. related to, the messaging has to be right. It has to be the right situation. You have to message it because there's a risk of, lack of engagement, for example, or employee morale. What impact does it have on that? Or what's the likelihood that those individuals are going to find other employment in the meantime? So there are all those risks that are still associated with it, but it does provide a safety net as it relates to taking care of employees in a situation where you just have to shut down your doors. And then finally, for those taxpayers who have received PPP loans, we are going to be moving to a situation where we are looking at how do we maximize the forgiveness associated with those loans. And particularly, how do all of these rules relate? So did we spend all the money on good cost? Okay, we have to do that. And then if we've done that, but we had to lay some people off in the meantime, or we had to reduce some salaries in the meantime, what is it that we can do? And does it make sense even to bring those back up to get loan forgiveness? Because I'll just say this, I think where I personally stand on this, and I don't know how others in the firm feel, but what I would suggest is make the right business decision first, because we've got some people talking about, okay, well, I'm not going to have enough wages. Do I just bring people back and pay them just to run through the funds? It's an option. But if you're not producing, it may not produce any cash out of pocket to pay those people using these grant funds, but you're going to incur additional costs, such as employer or payroll taxes associated with those increased wages. So again, I would say make the right decision for your business, and then we'll worry about how to maximize loan forgiveness associated with that. So that's really what I've got associated with this. I would just send you to these resources. Again, a lot's been put up. All of it's free on our website. Kelsey, I saw drop these slides in the chat feature. So again, you have access to them. We have a slightly longer version of this that we did internally with some situations. We did an hour-long presentation. And then if you're feeling really brave, an hour's worth of Q&A associated with that. Again, feel free to listen to that for additional detail. But let's take a look at some of these questions then. So did an organization classified as state government or owned by state government qualify or have access to a PPP? So if it was open to for-profit businesses, 501c3s, and then veterans organizations, which I'm going to blank on the code section, was that C19 maybe? But veterans organizations, 501c3s, and for-profit businesses. If you do not fall within those categories, you are not eligible for the PPP. They were very specific about that. Will the expanded unemployment payments impact future employment, future employer unemployment tax? Will it matter if you have had an unemployment claim in 2020? That I don't know. Again, the PUA, my guess is benefits paid under the PUA probably won't have an impact under that, because technically they're administering it as part of unemployment, but it is not an unemployment program. So that, those expanded benefits for people that have already run through unemployment, I don't see it having an impact on that. But again, I think probably more to come associated with that. Again, it's a maddeningly slow, but that's easy for me to say. I'm not the one trying to roll this out, with little lead time, but it has been a maddeningly slow rollout. But I would hope with the PUA that won't necessarily have any impact on that for 2000 and going forward. But, as with a lot of this, it does remain to be seen. To Matt's work, and I would probably start with Department of Labor, Missouri Department of Labor is where I would go for that. They have been trying, the Federal Department of Labor is providing updates as well, but at the end of the day, these are all going to be administered by the state. Missouri has a specific spot on its Department of Labor website where they've issued information related to this over the last few days, and I would continue to check back there associated with that. Randy Allen. Randy, I hope you're enjoying retirement. Feet kicked up probably with a drink somewhere, I hope. Will there be a reporting of some kind on the number of loans, dollar value, and demographics of the entities receiving the loans in the PPP program? I am not aware of that. Now, that's going to be something that politically I can see some individuals on the back end of this, sort of like the opportunity zone. They want to know, how are these funds used? Who got them and how are they used? SBA obviously has that information, but I don't know what the intention is on what they're, on what they're going to do with that information. But I don't think as we're here today, I don't think there's any way for us to see who's accessed those dollars, how many of those dollars have been accessed by Cole County. I mean, the individual banks here in town will know what they've done, but I'm not aware of anything that the SBA has released or will release that'll give any insight into that as far as who got the money on a community by community basis. Does that break down by industry, anything like that? I don't know that we have that.
Jeremy,
And Matt, so Randy, hopefully that answers your question. I think on that, we just don't know, but I don't know that I would anticipate anything like that. I know at some point they're going to probably roll out, someone's going to want to take a look at this, but I don't know where. Matt, that's an excellent point. I mean, as someone who's trying to get through to IRS, Department of Revenue, employment, there isn't a good answer to that as far as I know, because trying to get a hold of a human being in this situation, when people are commuting, teleworking, and people aren't working in the office and they're trying to plow through this, it is difficult. So other than that, I don't really know, other than the IRS is releasing all of their stuff online. They're telling you don't call, we're going to release it. I know Missouri Department of Labor is doing the same. I unfortunately just can't speak to how quickly it is that they're going to get that information out there. I do know the only thing that I saw yesterday is if you're someone that is typically not subject to unemployment, you're self-employed, they said, go ahead and use it. There's an online system, go ahead and use it. It's going to tell you you're not eligible. That's fine, because that's the first step for applying under the PUA, is that you are not otherwise eligible for unemployment insurance. And that's great, but that's where I understand the frustration, because that's where the guidance began, and that's where the guidance ended associated with it. Was basically do it, get kicked out. That's the first step. More to come on the application. Oh, I'm sorry, Randy. So not retired until July 1st. So good. So you may or may not have a drink in hand then. So you're good.
he's still lurking in the shadows.
He is. He's still there.
Yeah.
That's right.
Yeah.
Yeah.
Jeremy, I'm just going to ask everyone, if you have more questions, type them in. Since we've got Jeremy on the phone here, even though he covered everything, thank you very much, Jeremy.
Oh, you about 1/100th, Sean, but
well,
yeah,
you're superhuman.
There's a team behind this. That's why I've got this thing behind me. You can't see the team of people pulling the strings, but it's been it has been an absolute team effort. I mean, I mentioned some of those individuals firm-wide. There's a lot of information to disseminate. Our team has done a great job of that. And have a lot of people in our community have been doing a great job with it, particularly given the circumstances. I think we saw that last week, when Jason and Leslie were here, and we're all going to keep working through this together, because that's a lot of information here, but there is still a lot of information that we don't know, and we're going to have to work through together.
Jeremy, I think you've got one there from Trey.
Yeah, I'm surprised it took somebody this long to from the firm, from Williams Keepers, to give me some of these questions. I'd asked them for softballs. I figured they'd try to. Trey's question I do love. So can I predict when individuals whose last name starts with L, Trey is obviously asking for a friend, will get their stimulus payments? So yeah, I'll have to catch me over a beer, Trey, and we can prognosticate on that. But I thank you that's the question you threw at me, and not something worse than that.
Do we have any
defense Trey, probably before people whose last name begins with M? So there you go.
Do we have any additional questions from the audience? If we do, I'll keep this up. If we do have some come in, I'll be happy to take them, get them answered, and get an answer back to you. One thing that I would like to do is we start to close things out here. And again, thank you for everyone for being on this morning. We, the chamber, would like to do this each Friday morning So again, we'll be looking at next Friday, but we want it to be very relevant and information that you're looking for on your end. So if for the folks that are still on there, please, if you have a topic or a subject that you would like to have discussed, please send it to us, and then we'll get the experts from our community back on, and we'll have another Zoom meeting next Friday. But again, we want to identify a topic or topics for you. Real quick, Jeremy, Kim, thank you so much. Is there a way to find out is it EDL loan process is at?
Yeah, and that one's a bit trickier because those aren't through the local banks, but that's through the SBA directly. So I'm not aware of any way to sort of get around that. I think that's like everything. The process has slowed down a little bit, and they're taking a different approach to this, because I know there are advances associated with that in addition to the loans. And we've kind of received some additional guidance on that lately about how employees may impact that. So I know it's still a moving target. So I don't know, related to that, other than just continuing to check in through SBA. But the difficulty with that is that's not at least to my understanding, is not a local program. So, we can't call up our friends in the banking industry and bug them about that.
I'll let you take that one.
Yeah, I don't know, but it's someone who needs to get away for a little bit. I'm anxiously awaiting that as well. So again, we want everyone to be safe, but it'll be great when we can get things open back up again.
I agree. I think everyone is obviously antsy and want to get back to work and get back to socializing.
Can I chime in on that one? I don't know if you can hear me. It's Carrie Turgeon.
Yeah, Carrie, go ahead.
Is that the alcohol question that you were answering about?
Well, it was
alcohol?
about the when will government open. I might have missed it, although when will government open bars and restaurants? That's the question I was referring to.
Bars and restaurants. I did want to throw out there that we are following the governor's lead and working on that alcohol to go resolution or emergency. It's interesting. I have an emergency proclamation here in front of me that allows for alcohol to go. So I never thought in a million years that would happen. So that's kind of interesting. So yeah, that is out there. But we are working, of course, towards getting everything back open. But just wanted to chime in that we do have that locally too. Thanks.
Mayor.
Thank you. No, and
Yes.
Kim, I appreciate your question. As you might imagine, it's been a while since I've been to a, establishment such as that. So, obviously I can't speak to that.
Mayor, while we have you there, Kim Marshall, the salons, would you want to, there's probably the same answer, but would you want to tackle that, Mayor?
Sure. Yes, for when they would reopen. And I know that we're working right now with the Cole County Health Department. They ultimately make that decision, and they are talking closely with other health departments around the state about when a reopen could happen for businesses. Luckily in Cole County, our updated order did allow for non-essential businesses to open if they only had 4 employees and they had to wear a mask, and public can't come in, so doors have to stay locked, but they can do curbside. So that was an improvement. So you could see that we were working towards that. I've spoken with a few salon owners that have reached out to me, and my question to them has been, what do you need? Like, how could you open with the least amount of contact? Like, give me those ideas so I can share that with Cole County Health of how you can operate your business in a very minimal fashion and what that would look like. So we're trying to come up with how we can allow them to operate in the safest manner possible. And really the business owners are the ones that know that best. But honestly, a lot of times salon owners have told me, well, there really is no way we can do it without being in somebody's face. And, will they wear a mask or not, and those kind of things. So if we really have those safeguards, I think we can do it. And back on the restaurant question, restaurants are still open, just not on the inside. They can still provide curbside and takeout, although some have closed on their own because of the decreased business or just the concerns of their staff. But we're working towards that, and hopefully we'll have that soon.
Mayor, do you see we have from Randy, you know, the May 5th date? Do you think Cole County will match that?
I believe we will. Ours is currently the 25th because the governor's was the 24th. So we made ours the 25th to give us a day to react to the governor's change. Luckily, he made his a little bit out ahead, so we have time now to react to that. So I'm sure we would likely match his, but perhaps when we do that, if we need to make any kind of changes, we might be able to do that. So I do ask business owners to, you know, reach out to me with their suggestions, please. I know that's something we did with the non-essentials. We were able to say, hey, we can operate with like 2 people and doing curbside. So let us do that because we can prove that we can do this with no contact with the general public. That's harder in other industries, but I do welcome feedback so that we can perhaps make some changes, or at least I can suggest that as we're working through it. But I do want to say Cole County Health is working extremely hard on what a rollout will look like and working with other counties. And we want to do it safe. We don't want to get too complacent where we are right now because we know the reason our cases are low is because of the safeguards we've put in place. So we don't want to open back up in a manner that would cause cases to increase or spike. So we have to have that balance between the importance of health and business. And I think there's a way we can do it. We've proven we've done it up to this point. So I have confidence we will, but please reach out to me if people would like to. And I'll give you my cell in case business owners want to reach out after this call. My cell number is 230-7645. Thank you.
We had real quickly, Kim Marshall again was making a comparison to the salons to dentists, and then Trey, thank you for that answer. Okay. And then Matt Green, does the state stay-at-home order prevent? Okay. Any other questions? Again, I will take, you know, for future, possibly next Friday, future topics, subjects to discuss. You know, the chamber would be happy to get a local expert on the next Friday coffee if we have one. Looks like everyone's maybe played out for the morning. Here's what, okay, so here's what I'd like to do. First, what I'd like to do is say thank you very much to Jeremy Morris and to Jennifer Backus in the background helping us, and for our experts in the community, Williams Keepers, and many other experts that are working very hard behind the scenes, even though you don't see them out and about or cars driving around that much. We have a lot of people working, answering questions. It's a trying time, uncharted waters, but our community, you know, obviously strong community. Everyone else is dealing with this situation. I know we're all antsy to get back to work, as I am, very antsy. But again, thank you. Thank you for everyone being with us this morning. Again, thank you to Williams Keepers and Jeremy and Jennifer. What I'm going to do is, again, send me if you have, for next Friday coffee, if you have suggestions, send them to me, or maybe email me here at the office, or give me a call, leave me a message, and we'll go like that. So, Jeremy, anything else?
No, appreciate it. More to come on this. It's, you know, continuing to evolve. Hopefully better days are, when we know better days are coming, we'll just keep working towards it. Okay.
All right. Thank you, Jeremy. Much appreciated. Great information, and we're lucky to have you. With that, what I'm going to do is I'm just going to close it out for the morning. Happy Friday. Enjoy the weekend. Sun's supposed to come out tomorrow and a little warmer temperature. So go out, be safe, and spend some money. And see everyone soon.